I never attempt to make money on the stock market. I buy on the assumption that they could close the market the next day and not reopen it for 5 years. Warren Buffett. YouTube is filled with a lot of crash videos. Crashing skateboarders, bicycles, motorbikes, cars, funny road accidents, funny home accidents, you name it. And an entire genre exists. A lot of them are genuinely humorous, and we all enjoy watching them, laughing on the silly mistakes and occasionally learning from them as well. Heck, we ourselves have had silly accidents, smiling and laughing over it as we realize the silliness of our actions. However, all that laughter evaporates the moment we experience a different type of crash, one that comes unexpected and which ends up destroying your wealth and finances. The dreaded stock market crash. Stock market crashes can be scary as they tend to happen very fast and erode a lot of wealth. During the dot-com bubble of the 2000s, NASDAQ crashed 78% from its peak. That means your portfolio worth $100,000 was worth only $22,000. Now that is not only scary, but also depressive. The next crash, which was the great financial crisis of 2008, again saw markets falling 50% from their peak. That is half of your wealth gone. It takes years for the markets to go up and only months for it to come down. There must be a way to protect oneself from it, and in this video, we're going to show you just that. Renowned fund manager Peter Lynch said that the key to making money in stocks is not getting scared out of them. While the markets may have fallen 50% and your portfolio is in poor condition, nothing is lost until you book the loss. If you have purchased, say, 1,000 shares worth $100,000, even if the market falls by 50%, you still have those 1,000 shares with you. Only their existing value is lost. If you sell them after they have fallen by 50%, you will realize a loss, but if you don't, the loss remains a paper loss. However, it is easier said than done, and the crash can be quite distressing. Most investors throw in the towel when the markets have fallen by that much, since the entire environment around them spells gloom and doom and there is no hope in sight. Once the investors have given up and sold their shares, they find the market recovering and moving back up. In this video, I'm going to show you how to prepare for such a crash and to construct your portfolio in a way that you don't give up during that tough time and can in fact capitalize on the crush by buying up more, ensuring that your wealth is protected. Now, before we begin, let me declare in no uncertain terms, no one can predict when a market crash will come. All those screaming for a crash will scream 10 times and be right only 1 or 2 times. One must not try to time the markets or stop investing in anticipation of a crash, but instead keep on investing and staying alert for taking appropriate measures in case a crash begins to come. If the biggest investor in the world, Mr. Warren Buffett, couldn't get it right when he sold his airline stocks just before they began recovery and doubled from the bottom, we won't always either. Step 1. Deleverage and avoid margin. Most losses in stock market crashes occur when the holding capacity of the investor is lost. If you have $1,000 and you buy 10 shares worth $100 each, you own those shares fully. No one can take them away from you as long as you don't want to sell it. Brokers tend to offer a misleadingly sweet but actually toxic product called margin. Margin is simply leverage, money that the broker will offer you to buy shares. So instead of 10 shares, you now buy 100 shares worth $100 each with the same initial amount of $1,000, with the rest being provided by the broker. This means that the broker now owns the shares and not you. Now, in case the market moves up by, say, $10, in the first scenario, you will make a profit of 10 times 10, which equals $100. But in the second case, you will make a profit of 100 times 10, it will equal $1,000. That is the most attractive feature of leverage. It leads to large profits, but what leads to large profit also leads to large losses. In case the market falls by, say, $15, in the first scenario, the loss is 10 times 15, which equals $150. I say it is a loss because you still own the 10 shares and will continue to own them. In the second scenario, your loss stands at 100 times 15, which equals $1,500, which exceeds the $1,000 you put in. The broker will now ask you to deposit more money to cover that loss, or they will sell all your shares. In case you do not deposit the money, the shares are sold and you lose your entire $1,000, plus you owe additional $500 to the broker for the loss incurred. This is margin call. Most stock market crashes accelerate due to margin calls. At each level of a crash, there will be margin calls by brokers to their investors, which when not met will cause the broker to sell their shares off, increasing selling pressure and thus the crash. So the best way to avoid that and to keep your shares intact during the market crash is to own them outright and not depend on margin to own them. This ensures that when the crash comes calling, you are not affected by margin calls. In case some of you are on margin, de-lever and get rid of all extra shares right away at the first sign of a market drop. There is no bottom to a market when it drops, and the first drop should be a sign enough to get rid of the margin completely. Number 2, trim the losers and buy some insurance. Strength of a stock is determined by its relative rise and fall as compared to market rise and fall. A stock which does not fall much when the market falls is displaying strength and will be the first to rise when the market begins rising. Any market fall should be used to identify the strong and weak stocks in your portfolio. Sell the weak stocks on every rally and either load up on the strong stocks if there is cash to spare, or simply move the cash from your trading account back to your checking account. This is called keeping your powder dry. You can deploy the cash back into the markets when they crash, which will allow you to accumulate stocks at cheaper rates and generate more wealth once the market recovers. At the same time, identify other strong stocks that are not in your portfolio. They will be the ones that you need to add to your portfolio when the markets are down. Once the losers are identified and sold, some of the spare cash must be used to buy portfolio insurance. This is also called hedging the portfolio. This term is derived from the initial days of the trading between farmers and manufacturers who use agriculture products as raw materials. Farmers have always battled with nature as they strive to protect their crops and livestock from its mood swings. A particularly hot winter and a winter crop like orange will be destroyed. Too little rain and we have no rice. A bad case of bird flu and the entire chicken farm has to be slaughtered. Alternatively, weather has been so good that there is now a massive surplus of onions and there is not enough demand for it, causing prices to fall so low that the crops sell for less than the cost it took to plant them. Farmers will make a loss if crops are destroyed, and they will make a loss if the prices fall too much. A way out was desired, and a need was felt for a product that would help protect the farmers. But for a product to sell, there has to be a buyer as well who would benefit equally, if not more, from that product. To understand that, let us look at the counterparties that will be affected due to the mentioned events. With the failure of orange crops, prices of oranges will shoot up. Companies that make orange juice like Coca-Cola with Minute Maid or PepsiCo with Tropicana will have to bear the impact as they cannot just raise prices randomly. Similarly, if rice fails and prices shoot up, Kellogg's will suffer a loss in their Rice Krispies. A case of bird flu is bad news for McDonald's and their chicken nuggets. Companies who manufactured products depend on agriculture commodities would like to fix their purchase price in order to protect their margins. This whole exercise is called hedging. Farmers are hedging against demand uncertainties, ensuring that their entire crop is sold, and manufacturers are hedging against price uncertainties, ensuring that they know the price of their raw materials beforehand. That is why the Big Mac prices don't change every day. Now you know. The principle of hedging can be applied to stocks as well. However, hedging comes at a cost and is generally not necessary for retail investors, as the cost of hedging and other transactional costs will not be worth the protection being offered. Institutional investors tend to use these hedging tools to protect their portfolio and their customers' portfolio, as they have economies of scale on their side, and the costs for them are a fraction of what they are for retail investors. So one way to protect your portfolio against a crash is to buy a put option. A put option allows the option buyer to sell the underlying at a fixed price of his choosing on or before a fixed date. For example, a put option of Apple with strike $130 expiring in March 2021 will allow the buyer of that put to sell Apple at $130 either on or before the expiration date. It is an insurance contract expiring in March 2021, protecting the holder from a fall in Apple before March 2021. Institutional investors who anticipate a market crash will buy put options for their entire portfolio, which will help mitigate the loss from the crash. Now, Apple can go to $100 before March, and the put holder will still be able to sell at $130. This is a simplified version of the whole transaction, and there are a lot of complexities involved with it regarding valuation, time, contract size, etc., which we shall cover in a different video. The downside of this, however, lies in the timing of the whole thing. For any insurance, one must pay a premium, and it is no different in case of options. For purchasing a put option, one must pay a premium which will not be returned if the crash does not occur before the contract expiration date. Since we know that the market timing is very difficult even for experienced investors, one will continue to pay premium for that protection every month until the crash comes, which by the time it comes will have cost much more in premiums than it has provided in protection. As retail investors, however, we need to focus only on the first part, i.e., getting rid of losers and identifying the strong stocks to be purchased. Number 3, move to defenses at the first drop. Defensive stocks are those that do not move much in relation to the market. They are often mature, stable companies who have withstood the test of time as well as experienced several market cycles. One can identify them by their beta values. Beta of a stock is the sensitivity of movement with index movement. For example, a stock with a beta of +1 will move 1% up when the broad index like S&P 500 will move 1% up. Similarly, a stock with beta of +0.5 will move up 0.5% for an upward index movement of 1%, and a stock with beta of -1 will move down 1% when the index moves up by 1%. Defensives tend to have very low beta, and thus they do not move much if the market moves up and down. While this is bad when the markets are moving up, but very useful when the markets are moving down. Public utilities, fast-moving consumer goods companies like Unilever or Procter & Gamble, etc., tend to be defensive stocks. They pay a nice dividend as well. One can move their portfolio to defensives once the fall has begun and move back from them into strong stocks once the market begins to recover. Number 4, cut out all market-related news and information. Emotional control is very important in order to pass safely through the turbulent waters of the stock market, and crashes are the storm that tests them to their limits. In the epic Greek mythological poem, The Odyssey, the hero Odysseus has to deal with the sirens as he sails through an infested patch of sea. He asks his crew to put wax in their ears and asks to be tied to the mast so that he does not jump into the sea on hearing the sirens' calls. He also instructs them not to untie him until they are through, no matter how much he pleads. As they pass through the patch, they see shipwrecks and skeletons of the people who heard the sirens and passed through there, and who jumped out of the ships and met their end. Due to the precautions taken by Odysseus, they pass through unharmed. The same thing, it is best to turn off and tune out all market-related news and information out from your life, especially during market crash. Fear sells, and the media will do its utmost to sell it. Stop all news alerts and financial newspapers, including visiting financial news websites. Don't log into your brokerage account. Ask your family members to change the password and not tell you for a fixed amount of time. If you see it, you will be tempted to take action, and if you have access to the ability to take that action, you will take it. Take away the temptation as well as the ability to take action, and the protection will automatically be guaranteed. Any additional purchase that requires to be done can be done by the family member who holds the password. Remember, emotional control is of the utmost importance if one has to survive the crash. Most of the investors lose when they lose all emotional control. Generally, that happens at the worst portion of the market crash, which later on follows when the market usually recovers. Number 5, treat this as an opportunity rather than a disaster. Stock market crashes are a great opportunity to load up on good stocks that will become available at fractions of their original prices. So you went and bought some good apples for $100, right? Next day, those same apples are now available at $80. Would you buy them? That's a wonderful opportunity, isn't it? The stock market is no different. A stock which was a good buy at $100 will definitely be a good buy at $80 or less. However, a small caveat here. The company has to be good. Stock prices of bad companies fall rapidly. That does not make them a good buy. During market crashes, stocks of good companies fall as well, and that fall makes them a good buy. For example, if the market crashes tomorrow and the stock price of Apple falls along with it, that doesn't mean that Apple's business has suffered or it has made a loss. People are still going to need phones and laptops, and they will continue to buy them from Apple. Once the market recovers, the stock price will recover too, considering that its business was not affected. Stock market crashes should be used as an opportunity to accumulate all the good stocks at dirt cheap prices. It is not a time to despair when your $100,000 portfolio drops to $50,000, but a time to accumulate additional $50,000 worth of stock so that your wealth, when the market recovers, is much more than it was before the crash. Markets crash all the time. Yet, like the phoenix rising from the ashes, markets rise and rise strongly, reaching new highs in no time. Here's a chart of the S&P 500 since 1928. The gray columns indicate market recession or crashes and falls. As you can see, the market has recovered from each and every crash and is at a new high today as well. In the long run, equities always go up, and it will pay to hold onto your investments, even in the face of a market crash. Hopefully, now you are a bit more prepared and at ease. Feel free to let me know your thoughts in the comments, and as always, don't forget to like this video, subscribe to the channel, share it whenever you can, and turn on the notifications to know when the next video comes out.